Good afternoon. Thank you for joining us for today's webinar, 2021 at the Half. A couple of things before we get started, and I wanted to start on time, is we've got quite a bit of information in here today, and we're going to introduce some polling questions as well. But just a reminder, you are in presentation mode, which means hopefully you can hear me, but we can't hear you. So feel free to submit questions throughout the presentation, and we will take those at the end of the webinar. Secondly, we will send out an email that will contain a link to today's recording, as well as copies of all the slides. So again, thank you very much for joining us. My name's Sean O'Brien. At the bottom here, you noted I added something to my biography. I am not an economist. We're going to cover a lot of Fred charts today, so I don't want to mistake that I'm that, but certainly as a banker and a director at a community bank, I am like you, trying to follow the tea leaves and the breadcrumbs of what the Fed is thinking about and doing. So I look at a lot of these Fred charts, and I'll share with you them today and kind of what my thoughts are as we look ahead. As always, I'm joined by David Ruffin. David, for those of you who have not tuned in before, David joined us to start a division called IntelliCredit here at Quick Rate, focused on loan reviews and building portfolio analytical tools, both for management and just also for the loan review process. So he's going to take the second half of today's webinar, where we talk a little bit more about credit, benign as it is, and just the outlook as we move forward. Okay, so just a reminder, we're doing a lot of different things here at Quick Rate beyond our non-brokered CD marketplace. So if you haven't taken a look, I invite you to get a demo on any of these products. We'd love to show you what we're doing. As I mentioned, we've got a lot to cover, so I'm going to just kind of breeze through here the agenda and start moving into some of the slides. And so first off and foremost, right, this is a Fred chart showing GDP. You can see the V here in between, Q1 and Q2. It's not a complete V, it's a little bit of a square root, but clearly the economy has recovered. Whatever you want to call it, government relief, support, stimulus, any of the terms, it worked, right? I mean, we have replaced the GDP and got us back, on a firmer footing without much of a credit tail as we sit here today. Now, that doesn't come without some costs. The one that's most popularly spoke about and discussed, is all the government debt we're racking up to finance this. And the question is always, how do we pay for it? So you can see this is not a new problem, right? We've been really growing debt for a number of years, but it certainly accelerated again after the crisis, the recession in 2007, 8, 9, and then, here the pandemic in 2020. So it is a very large share of GDP, but have we ever seen anything like this? Well, yeah, we have. If you look back in the 40s and 50s, coming out of World War II, we had GDP or debt to GDP levels that we see today, and then you can see they came down pretty dramatically, and we've ever since the 80s we have been climbing ever since. So while it's not a great problem to have, it's not a completely novel problem. For those who, do believe in government spending, they would argue, and that this chart shows you, is what the cost to the budget is. If you think about it, governments are a little bit different, right? They really don't have an expiration date, hopefully, right? Hopefully the United States is here years and years into the future. So it's really the servicing of the debt and making sure somebody's always out there to buy it are the real critical factors. And so you can see, this chart shows you, as interest rates have come down since the 1980s, the amount and the percentage of the budget that it takes to support all this financing has come down, right? So to finance our debt costs us a lot less, and that's one of the reasons why people continue to believe that we should spend to make sure we get ourselves out of this and to create jobs and economic activity. Now, for those of you who've tuned into previous presentations, you're probably sick of seeing my slides, but we started this with the pandemic, or during the pandemic, and I still feel like it's the operating premise, right? We are still somewhat constrained in the economy as long as this virus is kind of hanging around. And I don't think that's necessarily changed, right? it's holding back what the true impact of the economy can be. And this slide just kind of reminds us from the Federal Reserve's point of view, they have a dual mandate, right, which is to promote price stability and the maximum sustainable employment. And those two things are known collectively as the dual mandate. The bullseye kind of shows you where they believe those numbers come together, and it's really about an inflation rate of 2% and an unemployment rate of about 4.1%. So clearly right now, the Fed is more focused on getting people back to work, and they are allowing inflation to run a little bit to run higher than 2% because they believe that's necessary to get to a more sustainable employment level than where we are at today. So that what's that leave us concerned about, right? What should we be thinking about as we we hear a lot of different talk about where the economy is and where it's going. One, right? Again, I just don't think we can get back to full normal until we get this virus more adequately contained. We're going to enter school and we'll see what happens, but hopefully, we are rounding the final corner on this thing and we can put it to bed in at least in some form or fashion. Inflation is now the new talk, right? Is it transitory? Is it not? The Fed clearly believes it's transitory. Now they have moved a little bit off of that. But again, they are going to wait and see still more than, act proactively like they did coming out of the last recession. Interest rates, they continue to remain low. The Fed has consistently said they're going to stay lower for longer. I don't think there's anything that's changed as of yet, despite all the talk, right? I mean, all the talk about inflation, and in the last 90 days, we've seen the 10-year go from 175 down to like 115, and now it's backed up a little bit to 125, right? So the bond market does not appear to be completely spooked just yet about inflation. Jobs, we clearly need more workers. We'll see if the turning off of the unemployment benefits, the return to school, if that helps, but there clearly is some stubbornness in the unemployment numbers, despite the recent gains in the job numbers. The eviction moratorium still in effect, student loan deferrals. So again, we've got a lot of things that are impacting the economy, and again, I don't think we can really get a sense of where we completely are until some of these things with the virus are better contained. Okay, so we're going to have our first polling question. You're going to lose the screen, the PowerPoint, for a second, but you can answer the question and then the PowerPoint will reappear. So if you could, just the question I'm interested in knowing is, do you believe inflation will be transitory as the Federal Reserve suggests? So I appreciate the people voting. We'll give it another 10 or 20 seconds here. Almost everybody's voted. Yeah, we'll give it, looks like we'll close it out here. So it's showing 58% say yes, with 80% voted and 42% no. So, all right. So thank you very much for taking a look at that one. We'll share this. Actually, you got to 59%. It's a 41%. So thank you very much for taking part in that first poll. We'll have a few more here in a second. All right, so moving on. The printing press clearly works. This is a slide that shows the money supply in the economy. As you can see, again, since 2009, it's been on a steady trajectory. And then in 2020, we really put it on overtime, and the money supply has really just kind of exploded here in the last 18 months or so. Now, the concern back from our days, if we think back to the 1980s and the economy and money supply, Milton Friedman, they all talked about the money supply would drive inflation, printing it. But the thing that's happened recently, and this is a graph of the velocity of the money stock, you can see that despite spending and printing all that money, the velocity of that money has not moved like it used to, and so it's not created the inflation that we saw back in the 70s and the early 80s. And so that's one of the reasons why the Fed continues to believe that they can kind of keep control of inflation, unlike what happened 50 years ago, 40 years ago. This is a chart of inflation and consumer prices. Again, if you look at this graph, if you look to the right where we are in 2020, 21, right, where it just doesn't look like inflation's a problem, certainly in a historical context. Is it rising? Yes. Does it seem like it's out of control? I would suggest from this chart, it does not. In the same way, if you look at expectations from market participants, do they seem concerned with inflation? Again, this is a 5-year break-even inflation rate. It shows you 3% here. Again, we're climbing, but we're not higher than we were even prior to the recession, and it just doesn't feel like the market participants are concerned about long-term inflation, right? They think I would again say from this slide, they believe it's more transitory. Same way even on the 10-year, right? Expectations climbing, but certainly not out of the realm of what we've seen in the past, and certainly not back here where the Fed jumped in early based on concerns about inflation running away, and they started to tighten, and then it brought inflation down dramatically. So again, I think lessons learned. The Fed this time is comfortable in letting inflation run a little hotter for longer because they do believe once they start tightening, they will slow it down. And again, this is just, we have seen this type of expectation before. So I think that's given the Fed more confidence to keep rates lower for longer. This is a slide that, the kind of the expectations for Fed funds. I can't say I'm a fan of this, right? That it's just showing, again, lower for longer, particularly on the front end for Fed funds, right? And so that certainly has ramifications for all of us in our margins. But again, I think if we're looking at what the Fed is telling us, they're telling us that nothing has changed in their mind about keeping interest rates lower for longer. Now, they are, we are beginning to see the last 2 months. We've seen really pretty, sizable jumps in, job creation, both over 900,000 jobs. You can see what's happened, in 2020, and then we slowed down at the end of the year, and now we've picked back up again in 2021. But we still stand about 5.7 million jobs short of where we were pre-pandemic, and that's what the Fed is focusing on, right? I think if we got a few more months of almost 1 million in jobs, then I think the talk of tapering and beginning to raise rates starts to happen. But they are focused on getting this back to employment levels that we saw prior to the pandemic, and so we're just not there yet. The other thing that is particularly troubling to the Fed is the fact the number of unemployed people 27 weeks and over. This, again, has potentially real long-term ramifications for the economy. One, no one wants to see anybody out of work for over a half a year. But secondly, does it suggest that people are unable to find a job due to their skill set, right? And in a rapidly evolving technology-driven or technological-driven economy, there's always concern of people being not properly trained to do the jobs that are actually available. Every day we hear about the record number of job openings, right? There's 10 million job openings currently in the United States. Why people aren't filling those, only can be one of two things, right? They've either retired, they've chosen not to do the work, or they're simply not qualified for the jobs that are out there. I think the Fed is, again, particularly concerned about that last reason, that people are not qualified for the jobs that they want, and again, are going to let the economy run a little bit hotter than they normally would. The labor force participation rate, again, this, begs the question: where have all the workers gone? Certainly a lot of them have retired. Some certainly probably have given up. I think there is a strong belief that when school starts, in-school person starts, people will return to the labor market. The infrastructure bill that's being bandied about, a lot of those jobs, are focused on trying to get, more people back to work. So all of those things hopefully will help solve some of these problems. But again, these are the types of things that the Fed is focused on because again, they are only focused on two things, the inflation rate and the unemployment rate. And they are clearly continuing to err on the side of getting people back to work. Okay, polling question number 2 is, when do you believe the Fed will begin raising rates? 2021, 2022, or 2023? So again, we'll just take about 30 seconds. If everybody would submit an answer, I'd appreciate it. Appreciate everyone's cooperation on that. We'll give it another 10 seconds here. And this is actually shaping up to be more interesting than I thought. So, all right, I'm going to close this. So this one, we see 53% think next year, but 47% 2023. So again, lower for longer. We shall certainly see. But again, both of those have really big implications for all of us in the banking world. Okay, so the Federal Reserve, has begun to modify their language. There's always a lot of focus and talk about what Chairman Powell says in his presentations. But the one thing that seems to be clear, right? Again, is he is focused, and the Fed is clearly focused on outcomes rather than forecasts. And so what that means is they're probably going to be behind the curve a little bit. But they are, again, continuing to suggest transitory is the name of the game. If we look at the 10-year, and I don't have to tell anybody on this call, right? It's remarkable where the 10-year is. Again, I think today it's backed up a little bit from the last couple of weeks at about 125. That clearly has been a boon for us with refinancings in mortgages, but it certainly has compressed, margins for new purchases of securities. And again, just really doesn't provide much of yield if we don't have loan demand. It's frankly, quite amazing. This graph suggests that we may have already seen some of the peak activity. The 10-year minus the 2-year Treasury, is a graph that the Fed does, and it, positive values, imply future growth. Negative values imply economic downturns. And while we're still positive, we have rolled over. It will be interesting to see if this starts to rise again with some of the infrastructure spending that will come. But again, it's to me, it suggests that maybe we've seen peak activity, and while growth will be steady from here, we may have touched past where the hottest growth would be, which again would play into the argument that the Fed is saying that inflation will probably be transitory. So what do we do with all this information, right? While earnings for us at the bank, as we're going to show you here in a little bit, as you already know, have been really good. Are we at a short-term peak? Certainly the last 18 months has seen a roller coaster with reserves. A lot of banks had started adding, thinking there'd be a COVID tail. They started adding, the larger banks did, in advance of CECL. And now we are seeing, obviously, the large banks release those reserves. And for many of us getting ready for CECL at the community bank level, again, we are seeing, kind of flat to even potentially releasing reserves as we move closer, to that transition date. Loan activity, will it improve or worsen from here? David's going to talk about the loan growth or lack of it here in a little bit. But, certainly for a lot of banks, this is our strategic challenge. Can we find the loan demand, in our markets organically to drive earnings in this low interest rate environment that, almost half of us believe, we'll be in for another couple of years. What impact will that have on our NIM, right? It's clearly impacted already. It doesn't feel like it should get worse from here. But again, we would love to be able to put more of that cash that is sitting on our balance sheets to work. Certainly, mortgage activity, it seems like everybody who should want to refinance should have. Hopefully the supply of housing will catch up so we can see more new purchases and create activity. But certainly that feels like that, pool of activity will be slowing down. And then again, our securities portfolio, right? Are we confident enough to extend maturities to get yield, or are we going to, play it safer and, take that opportunity cost or risk of waiting rates to potentially rise, and in the meantime keep that money in cash? But that obviously comes with a cost because the overnight cash is yielding nothing. So again, despite the fact we got through COVID really well, it is a very challenging time for us. Okay, polling question number 3. Do you expect the 10-year Treasury to be higher than it is today in 12 months? Yes or no? And there will actually be a second question to this one as well. And there was a question about the slides, and just to reiterate, yes, the slides will be available along with the link to the recording. We will be sending out, an email with those later this week. Okay, so the first question, yes, 86% of you believe the 10-year will be higher in 12 months. The second question, though, I'm interested in seeing or hearing is, do you expect the 10-year Treasury to be higher than 2% in 12 months? So if you don't mind doing a second question here, I'm very curious about this one because, again, it just speaks to, where rates will go. And so, again, this one is being answered kind of the way I would expect. You'll see it here in a second, but all right. Yeah, almost 80% of you don't believe that it'll be higher than 2% in 12 months. Okay, so again, thank you all very much for answering those. We'll continue on. This is a slide we had shown in previous presentations where we looked at what JP Morgan was doing as they prepared for CECL. You can see the huge increase in provisions in 2020, and then halfway through the year of 2021, they've reversed almost half of that provision. So again, I think, pre-COVID, before all of the relief and PPP loans and all the support payments the government provided, everyone expected there to be a credit tail. And then what we've seen is because of all that, there hasn't been, or it's been deferred. And so we don't really know. And so again, it's mitigated what we would have expected to see as a credit tail. Okay, the final polling question I'll share with you is, have you selected a CECL methodology? So we are, under about 18 months, the first quarter 2023 for transition. Most regulators are looking for us to be, running it side by side in 2022. So I'm curious to see where everybody is on that front. So we'll just give it another 10 seconds here. Okay. All right, let me share this with you. So 68% of you have selected your methodology and 32% haven't. So that seems like a pretty good path for everybody to be on. Okay, so what's ahead? Again, as I said, hopefully someday we're going to reach a level where the virus feels contained, and we can just have economic movement without any types of concerns. Move freely on airplanes, hotels, restaurants, bars, etc. Just move about confidently and freely. Hopefully this proposed infrastructure plan will create jobs. It, in fact, might be the economic boost the Fed wants, right? The Fed has felt like they have been going it alone because there hasn't been any fiscal response. They won't be the only one stimulating the economy this time. There will certainly, be some economic stimulus from that infrastructure bill. And again, it might be the thing that gets them to start tapering and then eventually raising rates. When will the home supply catch up to demand? Again, a lot of the inflation this year has been associated, with used cars, hotel rooms, and airfare. We saw lumber prices spike. They've kind of returned to their normal levels. So again, all of those things suggest transitory inflation. But I do think, again, hopefully, there's certainly a demand for homes. Hopefully in the markets that need it, we will see that supply catch up. Lower for longer is certainly going to continue to impact our bank margins. And will loan demand make up for that loss of margin? As we've talked about in previous presentations, I think if you're not looking at government types guaranteed lending, I think that's something we all need to look into have into our arsenal, because again, just some of the organic loan demand in our markets just aren't probably not going to be there. Will there ever be a credit tail? I just don't know. It feels like there should be, but it feels like it's certainly been postponed or prolonged. And then we'll see what the impact from CECL is going to be for the banks. I don't think it's going to be much of an impact because of the benign credit environment. I think if you're comfortable with the reserve that you have today, I think that's probably going to fly for the majority of the banks. And I think that's why certainly the accountants and regulators, and even the regulators, have kind of moved to a little bit more understandable and portfolio level types of CECL solutions to address it, because you're just not going to be rewarded for doing a whole lot of loan level work. Okay, let's just talk some performance trends before I pass this over to David. We have gone under 5,000 banks in the country as of June 30th. The call reports there's 4,999 banks. It's hard to believe. You can kind of see the breakdown, right? Almost 68% of the banks are under 500 million, but now only contain or comprise a little over 21% of the assets. Asset growth is still good, not quite it was so far in 2020, but a lot of deposits, a lot of assets at the bank. This is the troubling one. At the median level, loan growth was actually negative, for the last 12 months. That is of concern, and as you can see in this bottom graph, or these bottom two graphs, half the banks in the country, community banks in the country, had no loan growth over the last 12 months, and under 100 million actually have seen a contraction of over 2.5%. So that is particularly troubling when you think about where margins are and where interest rates are. Not being able to put money to work is really a troubling item. Deposits keep coming in. I mean, we are all flush in deposits. I don't need to remind anybody that. We know that here at Quick Rate. Just a tremendous amount of money in the system. NIMs. Okay, so again, we've dropped in the last couple of years. We've lost almost 50 basis points in NIM, but what you can see, we've held pretty good on loan pricing. Our yields are good. We've had almost a 54 basis point drop in cost of funds. And so again, the fact that this NIM is compressing tells us two things, right? One, we can't put money to work because the spreads are there for loans. And then secondly, there's just no yield coming from, or no support coming from, our securities portfolio. So again, trying to find more loan growth is critical for all of us. Again, I don't need to tell anybody that, but the numbers certainly confirm all of those suspicions. Despite all that, you've done a great job, continuing to drive ROE and strong earnings. Again, these numbers look fantastic. I think it's looking out 12 to 18 months, where we're starting just to think, how can we continue to drive these types of earnings? ROA and ROE, again, strong across the board, even for the smallest banks. So, that, continues to be encouraging, and congratulations are in order for all of you. So at this point, I'm going to pass the presentation to David, and he will take you through the second half, and I'll be back here in a little bit. Okay. Oops. All right, David, screen is yours.
Don't seem to see the screen. Sorry.
All right, hold on. Let me try to get it back to you here. Apologize, everybody. Well, it's saying you are.
I'm seeing poll results. Sorry about that.
All right, here we go. Yep, here we go. Now I think I got you.
Yeah.
I think is that your screen, David? Oh, we're waiting to yours. Let's see.
Do you see it?
I do not. What is that?
It says that you need close this. Yeah. Last poll.
All right. No, that's I don't want to do that.
Okay.
Well, you know what, David? I'll move the slides for you. I'm going to take it back, and I'll move the slides for you.
Okay.
Okay.
Okay. So hopefully everyone can see the slides on the 2021 credit uncertainties and the challenges that clearly persist. This is a bit of a broken record. Sean has alluded to it. 2020 was a much higher performance community banking year than ever was anticipated at the beginning of the COVID experience. The Armageddon that was feared never happened. There are a lot of temptations to claim our victory. We have a lot of reason to be comfortable because we got a lot of capital in place now. We have a tremendous amount of the fact that we don't get blamed in any way, form, or fashion. But the tempering of those victory claims, I think, are a lot to do with it was PPP. Now I'm seeing show my screen. Sorry about
Sorry,
that.
Dave. Yeah, that's my fault. I should have. I figured it out, and I thought I could give it to you. I should have jumped in to tell you.
So hopefully
Yep.
you can see it now. Right. Okay.
Yeah.
So
Thank you.
no problem. So much of it, again, everything that Sean has been talking about, in many ways, our industry has been the beneficiary of, which is the tremendous amount of government largesse, the PPP programs, and the regulatory respite that was offered largely in 2020. But here is the clear challenge that everyone on this call certainly faces, and that is, where are the growth borrower prospects in going forward? I call it kind of the taint of traditional debt. I don't mean to be trite here, but I've said this to several trade groups in the last few weeks. We've got a market psychology out there now that the prospective borrowers have to start getting back in the mode of, oh, we're going to borrow money that we have to actually repay. And that in and of itself is a market psychology challenge that I think we're all facing. And again, you're going to see numbers here, as you saw a moment ago, is we're in negative loan growth territory. There are a few states that actually have a pulse, but in terms of minimal loan growth, but in terms of organic loan growth, it is just simply not there. I say this again, we're still dealing with, relative to the survival rate of certain businesses that were significantly affected by COVID, who live on Main Street, not Wall Street. And I think that remains our focus, is to determine what embedded in our portfolio, frankly, has survival capabilities beyond that. But I think the market, one of the things that people ask me over the years, frankly, has been, what is the biggest single indicator of portfolio credit quality? And, we think in terms of cash flow, and we think in terms of collateral valuation as the two primary big elephants in the room in terms of credit quality. But the truth be known is, I think what drives the valuation for both of those items is whatever the marketplace values, what I call commodity valuation in its broadest sense, of all the products, the goods and services produced by our borrowers, I think is the single most impactful factor. And that is because it does determine supply and demand. It does determine revenue. It does determine margins, repayment capacity, and collateral value. So being aware of where the market is around valuing your customers or prospective customers' products and services is critical. There are changes already afoot in lending that we're dealing with. Obviously, the PPP program is gone, and there's a lot of struggle into figuring out how do we convert some of that PPP activity to organic loan pool. That in of itself is a challenge, because many in the community bank space, frankly, have moved a little bit away from a focus on C&I lending, and so much of PPP was C&I, or commercial and industrial, in its nature. As Sean just indicated, embracing the government guarantee programs for growth, critically important. I think it would be foolish now not to do that. And of course, there's loan growth associated, fee income associated, But my concern as a credit guy would be also it gives you the, if you will, the facade or the Band-Aid or the mask, whatever metaphor you want to use, to cover what might be a couple of years of weak credit standards vis-a-vis what normally would be brought in your bank as a new loan customer. And I certainly think that gives you that mitigant, if you will, to the regulator explaining why did you make a loan to someone that appears not to be have credit standards to the level that you're used to in terms of your normal prospective borrowers. I do think we're in arguably the greatest churn in our economy since the advent of the internet itself. And again, ferreting out the winners and losers, particularly in the delivery of these goods and services, is going to be critical. We know what digital shopping and the big box retail has done. That started well before COVID. It's been exacerbated by it. COVID has probably for the near future redrawn the paradigm of office space and how that is being used or looked at and financed. Sean alluded to this a moment ago. I think for particularly markets that are very dynamic, we're still living in frankly the taint of speculative lending that was basically, the fear was put on the entire financial industry to be sure you don't get out on a limb on speculative lending in terms of real estate. The net result of that, however, in certain markets in our country, is we have a dearth of inventory in wonderful family housing, which has driven up artificially the values there, and also the fact that again, we just don't. And this is really a lost opportunity, an opportunity cost for the banker who, in the past, has been able to keep a supply of construction of wonderful family housing. Most people are very paranoid about that. Nobody would advocate going back to the degree of speculative lending and at some point reckless speculative lending that was going on 12 years ago, but certainly going to the opposite extreme of avoiding any form of speculative inventory buildup in dynamic markets where people are moving and growing is really another example of where we're not being able to meet the needs of the marketplace, and it's an opportunity cost or lost for our bankers. Again, I mentioned this 2 or 3 years ago relative to the Tax Reform Act in terms of its de-incentivizing charitable contributions, but everything we're already beginning to see in some of our loan review work is that COVID has added yet another layer of stress to some of the smaller colleges and universities and nonprofits. And that is really something that I think for those of us in the community bank space need to be concerned about, because in many ways we were fairly aggressive in the last decade of diversifying into lending into this space. Certainly restaurants, hospitality come to mind. I have to give our good friend Kevin Fahrenkopf, CEO of the Bank of Hempstead, California, appropriate attribution for this, which I was on a panel with him with California bankers about 6 weeks ago, and he used the term, we ask our lenders, is it Amazonable? And his point being was that we have to start looking for a different potential target market of potential borrowers, and even operators like nail salons or tattoo parlors, which in the past may have been considered not necessarily an A1 target. At least they meet the standard that nobody can go to Amazon or the internet to get certain services done. And that may be yet another part of the churn that we're looking at in terms of where is our lending opportunity or opportunities going forward. I do think if I can take a moment at IntelliCredit, what we're trying to do in terms of the intermediate to longer term future for banking and for community banking in particular is to take what currently exists as very divergent, disparate inputs to management, bank management in particular, relative to 3 particular areas: stress testing, portfolio analytics, and loan review, often done by different vendors using different methodology, different points in time. But yeah, they meet a checklist that you say, well, we've had these things done, but in some ways their value is degraded because of all the differences and the differences in time, and that they're not synced. Our goal as IntelliCredit is to find a way to further sync all of these in such a way that it makes for a far more informative information flow to management. And in particular with loan review, which we do a good bit of loan review and have put a lot of focus on loan review, and this is kind of the spaghetti example of where the traditional loan review, highly intrusive, it's yet another audit, so to speak, another dedication of a lot of time by management to dealing with data dumps and shutting down to deal with the reviewers and so forth. We have done a great deal of work at IntelliCredit to make sure that we have streamlined this in such a way to make it less intrusive, far more real-time awareness and transparent of the flow of the loan review process and of your ability to collaborate with the review as well. Again, putting tremendous amount of efficiency in it to where one of our clients said, that gives us time to do our day job. So let me close my segment by just touching slightly on the national and regional credit performance metrics, as Sean said, as benign as they really are. Again, we tend to look at, in simple terms, three metrics in terms of the nature of your bank or your region or your state's credit quality. One is the inventory of problems, the chart to the left. That begs the question of what do you do with your inventory? You either charge it off or you reserve for it. Again, in this case, it looks as if the Southwest kind of leads, even though in a benign environment, about 1% of risk-based capital tied into identified as non-performing loans. Net charge-offs are inconsequential across the board anywhere this day and age. ALL to loans, it looks like the West has actually got a higher aggregate amount of reserves. It actually, the Northeast, the least, but that makes sense because the Northeast has very limited, very little non-performing loans identified. The inverse of that, the way I like to look at it is in this case, the Western banks under $10 billion, and that's our kind of approach to it. QCBI approach is community banks under $10 billion would be, they're covering their acknowledged problems over 3 times. Almost all of the regions are coming in at right around the 2.5 times. So we've got plenty of reserves, even in the face of what is arguably a very benign credit situation at this particular point in time. Again, I go back to the big problem on the table for everyone is loan growth. As you can see, nationally, there's negative loan growth. And among all the QCBI banks, it would be mainly in the 500 and above that are showing a little bit of pulse in terms of loan growth. But again, this is effectively a crisis for our industry as to where do we get loan growth, particularly in the face of what Sean shared with us in terms of what now is beginning to show as a return to a robust economy, irrespective of what has prompted it. In conclusion, we always like to be concerned about concentrations. We know that's both an opportunity for us in terms of our expertise, but it also tends to provide a high risk factor if particularly there's a turn in quality in a particular concentration that we have engaged in. These are the traditional broader 300% guidance on the right. The West is the highest of the states, of the regions. There are 241 nationally that exceed 300%. The chart to the left is the subset of that, which is construction and development loans. In this particular case, there are 162 banks nationally that exceed the 100% guidance. But I would argue this is exactly the case of where the missed opportunity may be, because there are certain markets, again, in our nation that are starving for additional inventory, particularly in the 1 to 4 family housing area, that traditionally banks have been able to step up and provide that. And how that's done without being excessively dependent on speculative lending or getting to some of the reckless patterns that we experienced a dozen years ago, I still think that's a challenge, but I do believe indeed that's an opportunity for banks in certain markets. And finally, other regional or other concentrations. It's not surprising the Northeast would lead in multifamily, given the concentration of population there. The middle graph here, C&I, really doesn't tell us much because of the artificial nature of the PPI involvement, and a lot of that was C&I. And of course, ag is, not surprisingly, the Midwest community banks lead the country in terms of risk-based loans to risk-based capital in that regard. So at that point, I will hand this back over to Sean, and thank you, and always enjoy being with you.
Thanks, David. I apologize to everybody. I didn't close out, despite many of you trying to tell me I hadn't closed out that last polling question. So I'm just going to briefly go back through those slides just to know. Secondly, again, we'll be sending these out, but just a reminder, again, we went under 5,000 banks. You can see the distribution, banks under 500 million, under 68% of the institutions, 21% of the assets. As we touched on, the asset growth has rolled over, but still strong. The loan growth that David just touched on, right, for the first time, I can imagine, a negative, growth at the median level over the last 12 months. Deposits, again, really strong. Everybody's flush with cash. That's our problem, right? We've got cash and nobody to lend it to. We touched on NIM, right? Here's that 48 basis point drop since 2019. The yield on loans, though, as we touched on, has remained above 5%. Cost of funds had a huge drop, and so again, it's emblematic of the fact that our real problem is lack of loan demand, and then any yield in from our securities portfolio. And then, as we touched on, the ROA numbers and ROE and core operating earnings, all very strong, pretty much across the board. And so again, I apologize for messing up those slides. If everybody wants to close their eyes for a second, I'm going to breeze through David's slides so we can get back on track here. But I apologize for not recognizing that I hadn't closed that polling question out. So as David touched on, we're trying to do a lot of different things here at both Quick Analytics and IntelliCredit beyond what we've built here at Quick Rate. Just a reminder, Quick Analytics provides a number of different things, from company reported data to SEC data, to M&A information, all things that, we think we can help you be more efficient and give you great access to information. CECL is coming. We can help. So if you're one of the 32%, I think it was, who haven't made a selection, we can help you. Give us a call. We'd love to show you our tool. For those of you who haven't looked at Quick Analytics, we also have a credit union data in the add-in tool now. So if you want to see what activity those people might be having in your market, you can access that in the add-in tool as well. So, we've tried to, build affordable and easy to use tools similar to what we've built in the Quick Rate marketplace. We'd love to give you a tour. We'd really love to get a quote. If you give us the opportunity to quote your next loan review, I think you'll see David and the team have not only will obviously do a great job with the loan review, but give you some other things in terms of analytical tools and reports that we think will, again, make the review process more efficient, but also give you and your team better information. So, I'd respectfully ask to let us bid on your next loan review. Again, IntelliCredit's made up of doing third-party loan reviews, but we have built cloud-based applications to, again, give you better insight into your loan level data, as well as if you do any internal loan reviews or annual reviews, we can give you software technology to make that process more efficient. Just a reminder, all the things we do in Quick Analytics, we've got peer reporting, we've got interactive pages on every bank in the country, and then we have a number of regulatory and compliance tools, not limited to just the CECL solver, but also a credit stress test. So a lot of things that you can have at your fingertips, but also have us here to help with. Before we get to questions, just a reminder to thank you very much for attending. Again, if you'll consider us for your next loan review, we promise we'll either match or beat the cost of your last review and provide you with technology. So we think it's really, hopefully, something you'll find interesting to take a look at. All right, so let me see if we got any questions. Again, if you missed the introduction, the slides will be available to everybody. Let me see what else we've got here. Okay. I think most of the questions are about me not having the slides or the poll questions still up there. So I think we just click through these, but I think we're there. Anything else? Okay. Well, again, I apologize for my error in not closing out that final poll question, but I do appreciate everybody attending today. I appreciate you taking part in the poll questions. Thank you very much for working with us here at Quick Rate. And again, please reach out to us. We'd love to talk to you about Quick Analytics, our CECL tool, and or all the tools in IntelliCredit, not limited to just providing a quote for your next loan review. So on behalf of David, thanks again, and we hope you have a great conclusion to your summer, and we'll talk to you in 3 months. Thanks so much. Bye now.